Light & Wonder Inc.'s Australian CDI, ticker LNW, finished the session on Monday, November 17th at 136.00 AUD, marking a strong gain of 4.34 or 3.30% for the day as the Australian market closed. Now that 3.3% pop is what most trading platforms will show you, a solid green day. But this isn't the real story. The real story isn't that LNW stock went up, it's where it went up. This isn't just another day of trading. This is one of its first days trading as an Australian native company. Just last week, Light & Wonder completed its major strategic move, delisting from the NASDAQ in New York and consolidating everything into a sole primary listing on the ASX. This wasn't just a simple administrative swap. This was a statement. The company, which is still headquartered in Las Vegas, has fundamentally tied its public valuation and its future to the Australian market, a market it believes is more gaming-attuned and will properly value its business model. So while many were just tracking the price, the entire field of play has been changed underneath their feet. The general expectation for Light & Wonder, especially coming out of its recent third-quarter earnings, was a bit of a mixed bag. The headlines that many investors likely saw, perhaps glancing at their Robinhood or SoFi Invest app, was the revenue miss. The consensus was looking for about $850 million, and the company posted $841 million. In a market obsessed with top-line growth, a market that treats NVIDIA stocks beat and raise quarters as the standard, any miss can be seen as a sign of weakness. The expectation becomes growth is slowing, the macro environment is finally catching up, and the stock should trade sideways or down. It's the kind of narrative that makes a quick-trigger self-investing individual sell the news. But the reality, when you look past that single top-line figure, is something else entirely. The reality is that the company's profitability was incredibly strong. It hit its earnings per share estimates and, more importantly, it beat expectations on adjusted EBITDA, pulling in $375 million versus a $363.5 million estimate. This isn't a story about slowing growth. This is a story about margin expansion and a successful shift in the business. The expectation is that LNW is just another slot machine maker, a gaming company. The reality is that nearly 70% of its consolidated revenue is now from recurring sources. This isn't the lumpy, cyclical business of just selling a new cabinet to a casino. This is the high-margin, predictable, and sticky business of systems, online content, and social gaming. This is what the market says it wants, but it seems to be having trouble seeing it here. The stock's recent daily movements reflect this exact tension. We saw the stock get a positive response after the earnings, even with the revenue miss, because the institutional desks, the ones using platforms like Interactive Brokers, weren't looking at the headline. They were reading the cash flow statements. They saw the operating margin jump from 19.5% last year to 27.2% this quarter. That's a massive improvement in efficiency. They also saw the company's aggressive capital allocation. Let's talk about what the big players are doing because it tells you more than the daily chart. In the last quarter alone, Light & Wonder returned $111 million to shareholders through share repurchases. They have already completed over half of their expanded buyback program, and management stated they plan to use a meaningful share of the remaining $735 million capacity before the end of this year. This is not the action of a management team that is worried about a top-line miss or a slowing economy. This is the opposite. This is a declaration that they believe their shares are undervalued and they are using their strong free cash flow to buy them back, transferring value to the remaining shareholders. This is a far more powerful signal than the daily swings you might see in more volatile names like Tesla stock. While retail traders on Robinhood stock trading platforms might be chasing momentum, LNW's management is actively contracting the supply of its own stock, which is a classic fundamental sign of strength. It's a move that would make Fidelity Wealth Management and Schwab Intelligent Portfolios take notice for their long-term models. Now, this big move to the ASX is the central catalyst right now. By exiting the US market, LNW is simplifying its structure. It's also making a direct appeal to Australian funds, which have a deep understanding of the gaming industry, largely thanks to LNW's primary competitor, Aristocrat Leisure. This is a high-stakes move. LNW is essentially telling the Australian market, "You will understand us better than the Americans did." This sets up a new dynamic. The stock will now be benchmarked daily against Aristocrat, and the pressure is on to prove its new strategy is working. The recent positive trading, like today's 3.3% move, suggests the Australian market is, for now, welcoming its new large-cap gaming constituent. But this also brings new risks. The company will now be more exposed to the sentiment of a single market. And it's not without its headwinds. The company itself has noted potential cost pressures from tariffs on components, and the macroeconomic picture, while resilient, is still a concern for consumer discretionary spending. Then there's the ongoing legal battle with Aristocrat over game mathematics, a complex and lingering dispute that adds a layer of uncertainty. So, what is Light & Wonder? For those who just see the name, it's crucial to understand the three distinct businesses. First, the gaming segment. This is the one everyone knows, the physical slot machines, the electronic table games, the systems that run the casino floor. This division is growing, driven by new cabinet designs and the acquisition of Grover Charitable Gaming, which is expanding its footprint. Then you have SciPlay. This is their social casino division, the mobile apps you see people playing that feel like a casino but use virtual currency. It's a cash flow machine with hits like Quick Hit Slots and 88 Fortunes, and its monetization is strong, with average monthly revenue per paying user up 11%. And third, and perhaps most important for the future, is iGaming. This is the real money online investing in yourself, so to speak. This is the engine that provides their popular land-based games to online casinos in regulated markets. This segment saw record revenue up 16%, driven by the U.S. market. The company's strategy is to be a cross-platform leader, owning the content and distributing it everywhere a player is, on the casino floor, on their phone for fun, or on their computer for real stakes. Looking ahead, the expectation is that the stock, now settled on the ASX, will begin a steady re-rating as the market digests its high-margin, recurring revenue reality. The catalysts are clear: continued expansion of iGaming in North America, the full integration and launch of Grover in new states like Indiana, and the continued success of their R&D engine pumping out new hit games. The risk is that the macroeconomic slowdown finally hits the casino floor, that tariff pressures squeeze those impressive margins, or that their big competitor Aristocrat simply out-executes them. Analysts remain broadly positive. The consensus is a buy, with price targets suggesting a healthy upside. They see the same thing management does: a company generating significant cash, buying back its own stock, and trading at a valuation that doesn't seem to fully appreciate its transformation. It's not a set-it-and-forget-it stock like you might get with some broad Fidelity ETFs or Fidelity mutual funds. It's an investment in a specific, high-growth, and highly competitive industry. This is a company that is making bold, structural changes to its business, and its stock price is now in a new arena. Comment below with your take. Do you think the move to the ASX was the right call, or should they have stayed on the NASDAQ to compete for capital against Apple stock and the other tech giants? In the end, we are left with this. The market's expectation for Light & Wonder was clouded by a simple revenue miss, a headline-deep narrative. The reality is a far more complex and frankly more compelling picture of a company aggressively managing its own transformation. It's a company that beat on profit, expanded its margins, is buying back its own stock at a rapid clip, and just moved its entire public listing to a new continent in a strategic bid to be valued correctly. The 3.3% gain today is just noise. The real story is whether this bold Australian gambit pays off. That's the reality that will determine its future, and it's a far more interesting story than a single day's closing price.